Hello friends.
Welcome to our channel. Today we are going to discuss about positive versus the negative gearing properties. It is very critical and very important subject to understand what is positive gearing and what is negative gearing. When we take our strategies to create our investment portfolio, it's very important to understand every critical information that we can find related to this kind of properties. We need to understand this positive versus the negative gearing properties because this will help you take decisions accordingly to build your own investment portfolio. Friends, I had already mentioned in my couple of other videos that wealth is something that you need to generate and that will secure your retirement in the future. We should be able to cope up with the short term pains in order to get the long term gains. So let's understand properly what is positive and negative gearing properties and how it can help you in the future secure your retirement and also to help you build your wealth as well as you go. So let's go ahead. The topics we will be covering in this video will be what is the positive gearing properties, what is the negative gearing properties, what is neutral gearing properties, what is a good or bad rental yield, advantages and disadvantages of negative gearing properties, what should we be aiming for when it comes to creating an investment portfolio, that is the strategies, how the strategies can build or break your investment portfolio. That's something we need to discuss as well. Now let's discuss about the positive gearing properties. Let's understand this word as positive gearing, and before understanding positive gearing, let's understand the word gearing itself. In a very basic level, the gearing means money you borrow to invest. The money or the dollars or the rupees that we borrow to invest is called gearing in the financial world. And the positive gearing property, what it means? It means it is an investment property that generates more income than it costs to maintain, resulting in a positive cash flow. This means that the rent you receive from the property is more than the interest payments, property management fees, repairs and maintenance cost, and other expenses associated with the owning of the property. What it means is that it can be a very good strategy for the investors who want to generate income from their investment properties from the day one itself. It can also help you build a very good portfolio investment faster, as the extra cash flow that comes from those properties can be used to fund or for the deposit for a new property. However, it's important to note that positive gearing can also be a bit risky. If the value of the property decreases, you would end up owing more on your mortgage than the property is worth. Additionally, property gearing can also be used to offset your taxable income to a certain extent. So friend, what this means is that the moment you bought a property and if it is in a very good location and it is how high demand, then in that case there will be a chance that your rental income will be more than how much you pay to maintain that property. So say for example, you have a weekly rental income from that property as 500 Australian dollars and your weekly expense is 410 Australian dollars. So weekly you are going to, so how you are going to calculate is that here the rentals are always done weekly. But when it comes to expenses that we pay towards the property might not be weekly, it could be monthly or mostly annually. But if you divide that with the number of weeks in a year, then in that case you will know that how much of your payment is actually going towards the house per week, and then you can do that maths or calculations. Now, in the positive gearing properties, the calculation can differ from weekly or they can do it quarterly. Many times they can do it monthly or even annually. So it depends on you how you wish to calculate it. So in a positive gearing property, how I have done the calculation is weekly. So say for example, the weekly rental is 500 Australian dollars and your weekly expense is 410 Australian dollars. So you now have a buffer of 90 Australian dollars that will always come into your pocket or into a bank account. Now that 90 or Australian dollar that comes to your bank account is called the positive gearing property. That will help you show to the bank that hey, you know what, I bought a house and that house is now generating lot of cash flow into my account rather than my account getting planed out because of how much expenses I'm putting into that house. Now there are benefits and demerits for both, which we will talk later on in these slides. But for now, we need to understand what is a positive gearing property. In plain words, positive gearing property is a property where you get more cash into your account than how much you actually put into that house. Now let's understand what is a negative gearing properties. So negative gearing property is an investment property strategy that generates a less income that it costs to maintain. So basically your property is negative geared if the income from your investment is less than your interest payments and any outgoing payments that you do towards the property. This means that the rent you receive from the property is less than the interest payments, property management fees, repairs and any other costs that associated with that property. Often these kind of negative gearing properties are referred to as capital growth properties. Negative geared investments are expected to appreciate in value over the time, not immediate but over the time, and this increase is expected to outweigh any short-term financial losses. So let's take an example. So you have a house or you bought a property in some rural areas or in some growth areas, but it's not going to grow immediately, but you have a strategy that it will grow in the future. For the reason you got a house over there. Now when you got a house over there, the weekly rental that you got from there was 425 Australian dollars. Now the weekly expenses that you are putting into that house is 440 Australian dollars. Now if you see, there is a shortfall of minus $15. So $15 you are paying from your end towards the house to maintain and manage it and to hold on to it for that long term gain that you might get in the future. Now for that reason, these kind of properties are termed as negative gearing properties. Again, this is another strategy many investors also take, and we will talk about it in the next slides or in the future slides. So let's understand more about what is neutral gearing properties. It's very simple. So you understood positive gearing, which will give you some cash flow. Negative gearing, where you are taking out your money and giving it back to the house, where the cash flow is less than what you are actually paying for. But in case of a neutral gearing property, the cash flow is not there, but you are not having any profit, neither you are having any loss. A neutral geared property is an investment property that does not generate less or more income than it costs to maintain, resulting in a neutral cash flow. This means that the rent you receive from the property is similar or very much equal to the interest payments, property management fees, repairs and maintenance cost. So say for example, you bought a property in a very good area, but in that area what you have seen is that the council fees and everything is very expensive. For the reason your weekly rental might be 500 Australian dollars and your weekly expense is 500 Australian dollars. In that case, neither you are getting any loss or neither you are getting any gain. But the good thing is that you are having a property which will always appreciate its value in the future. So that's all about understanding the positive gearing, negative gearing and neutral gearing properties. If you still have any queries related to positive, negative and neutral gearing properties and what are the strategies that you need to follow in order to gain that long-term growth of your investment portfolio, then please do not hesitate to put those informations in the comment section. I will definitely will come back to you on that and will let you know what's the right way to do and what's the right choice to do. Again, like I said, I am an investor myself, but not everyone's strategy are the best, not everyone's strategy are good. It just depends on how you play your own your own ideas and how you can build your own empire by yourself. Whenever a money is involved, it's always good to use your own due diligence rather than just copy pasting any other's ideas, because it could be favorable in that condition for that person but might not be for you. So please do a lot of research and ensure that you know everything before you put even $1 in any of the investment ideas. What is a good or bad rental yield? And before that, we will just have a discussion about what is rental yield itself. And rental yield, I would say, is a very critical subject to understand, and it's a very critical information that you need to have in order to place your own pawns accordingly on the chessboard before you move to your next investment portfolio. Even for the investment portfolio, to build that kind of investment wealth, you need to ensure that you know all the jargons that are used in order to make sure that you take the right decision in building your portfolio. So what is a rental yield? It is a measure of the income a property generates as a percentage of its value. It is calculated by dividing the annual rental income by the purchase price or market value of the property and multiplying by 100. Let's take an example. If you buy a property for $500,000 and it generates $20,000 annual rental income, then your rental yield will be 4%. Like I said, If the rental yield is higher, then you are actually in a more better position when it comes to investment. If the rental yield goes down, then you might be suffering a bit of a loss in the investment industry. However, it is very important to note that rental yield is not the only factor to consider when investing in property. Other factors such as the location of the property, the type of property, and the condition of the property also affect its profitability. If you are looking for a property that will generate a high return of investment, you will want to focus on property that is in desirable locations and are well maintained and have a very high demand for rental housing. Here are some examples of good rental yield properties like apartments in major cities, houses near the universities, well-maintained properties in very desirable neighborhoods, small properties that are easy to maintain, properties in very high demand areas. These are some of the factors, or these are some of the things that you need to take care of or consider if you're only looking for good rental yield properties. Thus, the negative side of it is that they are very expensive as well to buy initially. The other examples that I can give you regarding how the other places or the factors that can come into your bad rental yield properties are properties in the rural areas, some of the rural areas, but like for example some of the regional areas where the property prices had not grown significantly. Initially you might have to incur a lot of loss because of it, and because of that your rental yield will be very low. So those are the areas that you will always get some kind of bad rental yield. Then comes the properties in poor condition. So say for example you bought a house and that house is very bad in shape, and it doesn't have the right conditions where you can stay in there. Those kind of properties can also give you a lot of bad rental yield. Large properties that are expensive to maintain, properties in low demand areas, properties with zoning restrictions. So with that we close this good or bad rental yield topic, and we hope that you do understand about it. If you need to know more about it, please do not hesitate to let me know in the comment section, and I will be happy to give you more information about the rental yield in the future videos. We are going to talk about the advantages and disadvantages of having a negative gearing property or a positive gearing property as well. Now, these are some of the positives and negatives that we need to understand if you are going with either of the strategy. Like I said, neither of the strategy are the best, neither of the strategy are the bad. It is all upon you, on your decision how you want to build your portfolio. Now you can choose positive gearing only, or you can choose negative gearing only, or you can choose a mix of both. Now we will just go through the positives and negatives of each of the strategy and see where it all belongs to. Here are some of the pros and cons of having a positive gearing property. The pros are generating the income from day one. It's very simple. I had already made you understand that what is a positive gearing property. So yes, the moment you have a positive gearing property and you put it on rental, immediately the income will be from the day one itself. You will start getting money in your pocket or in your account. Build a property portfolio faster. Again, very true, because you are getting the money into your pocket rather than you are spending more towards that property. Now you will have to, it can build up some more cash for you that you can use to build a next house or to buy the next own property and then put it on the rental again. Offset your taxable income. True. The positive part of it is that you can offset your taxable income. Now, I will not go further into the taxable. There is a different subject that we need to understand how the taxable incomes are offset in the Australia. But if you really want to understand that part, please do let me know in the comment section, and I will be happy to guide you through or to help you through by doing some more research on it. Capital gains potential. Whenever you go for a positive gearing property, in that case, that location is really good. In that case, that location have a lot of demand. So indirectly or directly, that will affect your capital gain. So it will always ensure that your capital will always grow with time, and that too might be in substantial amount of money. So for that reason, many people usually go with a good positive yield or positive gearing properties, because they know that this location is going to always increase by anything. Like for example, in Sydney, if you see, no matter where you put a house, it will always grow, because the demand is so high in NSW that any location that you put a house, it will keep on increasing. But there are different factors that need to be considered in order to take the decision whether to go ahead with the positive gearing or the negative gearing or a mix of both. The negative part of having a positive gearing are risky if the property value decreases. Now, you might just ask me that you just mentioned a couple of minutes back that the capital gains potential, then why you are saying that the property value might decrease? It could be, and it can decrease. The reason behind it is, there are, like I said, right, there are a lot of external factors. It's just not the internal factors within you, it's the external factors. Say for example, something was found in that area where you are where you are residing, or you just bought a house. You bought a house in a very good suburb, but post a few years you found that that house or that land where you have built the house have some issues with the sinkhole, or some kind of issues from the council itself, and that will immediately decrease the value of your house or land. Or say for example, you are in a very good suburb initially, but then after that the council decide to put a kind of a electrical fence or some kind of telecommunication tower just in front of your house. That definitely will impact your capital gains, and it will immediately will decrease the value of your house. So there are many factors that can come into why your property might decrease the value in time, right? But saying that, it is very unlikely that it will happen. But if it happens, then it is a big risk for a for a positive gearing property. The reason behind, in that case, you are paying a lot of money towards your house, you are getting a lot of money, but with time you will see that your property value actually is getting decreased, and it is actually impacting you indirectly or directly. Now, again, from the taxable income, you can only offset to a certain extent. You cannot offset the whole taxable income, because the thing is that you need to understand, taxation is done on a certain limit. Like the when the income of yours goes to a certain limit, then only the tax comes into picture. If that limit is not reached, then there is no taxation to it. There will be no taxable income to it. So say for an example, you have a salary of $100,000 for yourself. So you are doing a job and you are getting a salary of $100,000, and on top of it you are also getting $50,000 from the property itself, or $30,000 from the property itself as a rental income every year. In that case, you have to show it to the tax, and they will be doing the taxation on the total of $130,000. 100,000 as your salary and $30,000 as your rental income that comes to your account. Then the whole amount will be taxed. More expensive to buy. So yes, like I said, positive gearing properties are always in a very good location. They are always in a very high demand pockets. So whenever you go and buy a property in those high demand pockets, you have to pay more in order to get those kind of properties. So it is always expensive to buy. Higher ongoing costs. This is another factor that you need to understand, because the thing is that with each year or with each quarter, the council might think or might consider increasing their cost. The council cost, the utility bills, the other management fees, or they might increase your insurance as well. Now say for example, you bought a house, you put it on rental, post 6 months you saw that the tenants who are staying in your house, they have damaged a certain portion of your house. Now you need to fix it. In order to fix it, you have to apply for insurance. When the insurer will come and check the damage and will give you the money back, they will also increase your premium. So that will also increase. So for that reason, it's very important to understand what are the factors which you have to consider, and the risk that you need to take in order to grow your portfolio. So it's very easy that to say that we can generate wealth very quickly, but it is not true. The truth is that you can generate the wealth, but you need to understand and take cognizant of the risk that comes along with it as well. Now let's talk about the pros and cons of a negative gearing property if you own. Now the positive parts of it are potentials for capital gains. Like I said, not all the negative gearing properties are bad, but it all depends on your own research on what you really wish to do and how you wish to take it forward. Offset your taxable income. A very good consideration on how to save tax is just use the negative gearing property, because you are incurring loss in your business. The investment is like a business for you, right? So you are incurring loss in it. You are paying more towards the property than you are actually getting out of it. So in that case, what you need to do is that you have to, when you go and talk to your tax accountant, you have to let him know that this is the property which is a negative gearing for me, and then they will do the tax rebate for it and might offset that taxable income into your account as well. So that's a very good way of saving tax. Of course, you will definitely feel some short-term losses. You might feel some crunch in your pocket when you see that your money is actually going out of your pocket rather than coming into your pocket. Now that is fine. From the investment strategy point of view, that is up to you how you decide and how you move ahead. So yes, there will be a bit of a short-term losses in order to get that long-term gains if you have done your own research properly and you know which area and suburb you are investing into. Risky if the property value decreases. Like I said, right, there is always a risk that will come into factor when it comes to investment. And because of that risk factor, even though if it is 1%, many investors actually pull out of the game and they used to play it very safe by not investing at all, which is again a very wrong advice I will give, right? You should not be doing that. You should always move ahead with that. You have to be strong enough to ensure that you outweigh those risks and go ahead with your strategy. Believe in yourself, believe on the strategy that you have built, and you will definitely will achieve what you actually had vision for. Now, the risk of the property value decreases can happen because in some suburbs or regional areas where you might have seen a potential that it will grow in the future might just flip off, saying that that area will not grow for the next 20 years because of some reason. Say for example, the federal government just stopped the budget, or they have just cut down the budget by half or even a quarter. So say for example, like in Victoria, right, in the regional areas there was a huge demand that this will grow because of the expected Commonwealth came, but all of a sudden just in a couple of months back stopped the decision. They just took a decision that there will be no Commonwealth came that will happen in the regional areas, and immediately that actually impacted a lot of regional areas because the small businesses were all waiting for those kind of opportunities to have. Now these kind of decisions from the government or from any external factors can actually impact your property value that might decrease. The next point will be the more expensive to buy, and the last one will be higher ongoing cost. These are some of the factors that need to be considered when we are choosing the right strategy, whether we are going for a positive gearing property or a negative gearing property. Now, this is a question that many people do ask, which strategy to follow. I would say no investment strategies are the best or the bad strategies. So any strategy that you wish to create, you can create by yourself by doing a lot of research, understanding the rental market, understanding the property market, understanding the demography of that location where you wish to invest. Doing that, it will give you a clear picture on where you wish to move ahead with. Investors have made wealth using positive gearing strategies and also from negative gearing strategies. It is very much similar to the game of Monopoly. Sooner the better. When you had played Monopoly, it is very similar to how an investor actually plays in the real Monopoly game. So in Monopoly, when we start playing with our competitors, what we try to do is that to reach to a certain location which is high in demand. And if you have seen in the property Monopoly game, in that also you will see some properties who will not have that much of rental, say for example $10 to $5, something like that. But there are some properties like US or some kind of properties which are Mexico or something that will generate a lot of rental for you, right? But saying that, no, if you had played it deliberately, then you might be also aiming for that low income location in order to get something out of it, even though there is a lot of loss that you might incur in the initial stage. But in the long term, if you can buy all the properties from that same location, so say for example there are two low income location, if you buy it together and you build houses on top of it, then it will generate 2 or 3 times more than the rental that it was before. So if it was $10 and you have bought two locations at one go, and then you have three houses on each, then it might give you $70 to $80 more. So it all depends on how you strategize your monopoly game, right? The same thing happens in the real time strategic to take when it comes to playing the investment game. There is no one size fits all answers to the strategy type question, as the best property investment strategy for you will depend on your own individual circumstances and your investment goals. So guys, please do work on your goal, create small milestones, and on that milestone start moving ahead in order to achieve that goal. Once you start building that first two milestones, you will immediately realize that how easy it is to achieve the goal. It's always very hard to take the first baby step. The moment you take that first baby step and you move ahead, it will be very easy for you to start sprinting towards your goal immediately. So I wish you all good luck, and I hope that this video will be informative for you. If you have any feedback, please do let me know in the comment section. Till we meet next time, thank you all and goodbye.